Investing is great, and many are doing it now because, well, it's awesome. If you're looking to understand stocks and real estate better and to have both of them crystal clear in order to understand which one you should get started with, today is the video for you. I'm going to explain to you in a very simple and straightforward manner how all this works, how it can make you money, and which one to choose. I know that there are tons of videos on this topic, but most of them are actually intentionally complicated. Why? Because they want to sell you a course or waste your time on useless webinars that will explain it better. So, without further ado, let's get started. Stocks are literally pieces of a company that you buy. Well, they aren't physical pieces of the building, of course. The stocks are just equal to a percentage of that company. If you're already lost, try to stay with me. Every stock has a price, and of course when you buy that stock, you now own a small percentage in that company. Now, when you buy a piece of a company, you now own a piece of that company. And of course, companies exist to make profit. So, depending on the stock that you buy, companies usually produce a dividend. A dividend is a payment which is issued by the company and is a part of the company's profits. So, for example, if we look at Microsoft, Microsoft is a publicly traded company with a dividend yield of 1%. This means that if you own Microsoft shares, for every 1% of Microsoft company that you own, you will receive your money back essentially. So if I own $100 worth of Microsoft share, at the end of the year, I will be paid $1. Is it starting to make sense? So, of course, this dividend yield of 1% is considered quite low, but Microsoft is what you call a relatively strong and stable company, so the dividend yield is likely to be lower. However, there are other companies that exist out there that have higher dividend yields, ranging from 7 all the way up to 20%. Now, if I have $1,000 and a company's dividend yield is 20%, at the end of the year, I will receive $200 simply for owning a piece of that company. And this is how people use dividends. They use them to develop a passive income stream. And they're great because you don't have to do any of the work. All you need to do is to simply own that stock or own that share, and you will be paid depending on the amount of shares or percentage of shares that you have. So many people will use this information to actually generate an entire dividend portfolio where they can generate a full-time income simply from owning shares within a company. For example, if I had $100,000 worth of companies in my stock portfolio, and let's say the dividend yield was around 20%, I would receive $20,000 every single year for simply holding my position within those companies. Now, of course, if I sell those shares, I lose my dividend yield because the dividend yield is only applicable to shareholders. Therefore, it is quite advised and quite attractive to keep the shares and hold them for the long term so that you can receive your dividend payout. However, there are some slight problems when it comes to dividend investing. Of course, since you own shares in a company, those shares can fluctuate. But why does the price of stocks fluctuate? The price of stocks actually doesn't always represent the value of a company. I know that sounds confusing, but let me explain. You always hear buy low and sell high. That simply means you're supposed to buy a stock when it is undervalued so that you eliminate almost all of the risk that a stock will lose value over time. In order to do that, you need to calculate the intrinsic value, which is basically the real value of a stock. I'm going to explain to you how you can do that today because it's pretty advanced, but it is very fundamental when it comes to investing in stocks, and it's going to give you an insight of what a real company is valued at. So, if you decide to invest in stocks, you need to look that up. The real reason why stock prices go up and down every day like crazy is simply because of the game of demand and supply. When a stock is very demanded, the price is expected to go up since everyone is buying it. And during recessions, or when a stock isn't demanded or oversupplied, the price of a stock will go down fast. Also, there's a lot of speculation around stocks and investing. So opinions of famous and influential people, for example, Warren Buffett, also known as the greatest investor on earth right now, these opinions can really influence the decisions of investors, and markets could crash just because of popular opinions and speculations. It's quite like gossip, but for investors. We always talk about who's going out of business next, and who's losing and who's making money. So, when it comes to stocks or dividend investing, you have to make sure you know exactly what you're doing, because as you all know, since the coronavirus started, many companies have been going bankrupt, and they have also been slashing their dividend yields, meaning that they may have yielded a 10% return on dividends at first, but because of the pandemic, they could have reduced it to around 5%, meaning that your dividend yield is actually going to be quite lower. Therefore, you need to understand and pay attention to what's going on with the company that you're invested in, because at any time, especially in today's uncertain markets, dividend yields can change, stock prices can fluctuate, and you need to stay on top of it to ensure that your income stays relatively stable. Now, on the other hand, we have real estate investing. Real estate investing isn't that different investing from stocks. The key principle is the same. Buy low, sell high. How is this valid for properties? Simple, you buy undervalued properties that have been mistreated or mismanaged, and you fix them up, you rise the prices, and you sell it or rent it out and make a profit. In order for the price to rise, one should wait for some time, but there are a lot of factors to consider. First, you need to understand that investing does take a lot of research. And it doesn't matter if you're investing in stocks or properties, you do have to know what you're buying. As Warren Buffett says, never buy something you do not fully understand. The guy is so trusty of that rule that he has never invested in internet-related stocks just because he doesn't understand them. And he's a billionaire. So yeah, you might want to listen to that advice. You can invest in homes, commercial spaces, offices, anything. But it is recommended to start small. So, with homes or with very small commercial places like gas stations. In the case of real estate, you have to do heavy research on the neighborhood, the history of the place, its reputation, and more. A good point I learned from Manny Kobsin is to look for easily modernizable properties. These could be homes, offices, commercial centers, or anything else. Modernizing the place means making it look more up to date, and in most cases, especially if the location is right, you can take an older home with an outdated paint job and style and transform it into a modern looking place, so a more valuable piece of property. However, you need to understand that property is of course a very, very stable source of income, quite more stable than stocks and dividend investing. The reason being that when you're dividend investing, you own a piece of the company, but you don't actually decide what happens with the company. Whereas with real estate investing, you actually decide what happens with the property. For example, if I were to purchase a house, I could decide to increase the value of the property by adding bedrooms, bathrooms, or adding a modernized paint job, which would thus increase the rental yield. However, if I put that same amount of money into dividend producing shares, I don't have any control over how those companies are run and how those companies are perceived. Therefore, my investment is much more risky because I have no idea whether or not the stock will increase or whether or not the dividend yield may go down. Now, of course, this is all speculative, but at the end of the day, depending on what you want, you may realize that real estate investing is quite more secure. However, real estate investing is much harder to get into because with dividend investing, all you need to do is buy the stock and you get your dividend yield. But with real estate, there are many things such as mortgages, many things such as forms that you need to fill out, many checks that you have to pass. So real estate is much more complicated and dividend investing is much more simple. I would say a mixture of both these investments would secure you a very nice passive income stream. However, you just need to evaluate what it is that you want from your income stream. Do you want an income stream that you can quickly pull money out of, like you can with dividend investing, or do you want a long-term investment in a secure place with money that you know you aren't going to use? Then perhaps go for real estate investing.